Again, it had no sales or anything like that. So people at Wall Street Journal recognized that, okay, this thing is going to be big, the social media thing. This is, I think, 2006 or 7. I'm not sure exactly. So they bought MySpace for about $500 million. Do you know what MySpace is worth now? Probably nothing. It's basically where you find all sorts of perverts and turbulence. It's kind of the dark web of social media. Because once Facebook came, nobody wanted to have a Facebook account. Oh, I'm sorry, MySpace account. So now, at the time, I don't remember what it was. MySpace didn't have much assets anyway, so most of that 500 million was booked as goodwill. But within probably before 2010, mostly journal accountants must have realized that, well, there's Facebook. I don't think our company is worth much. So you say, okay, it's not worth 500 anymore. You estimate maybe it's 100, then you write off that 400 as asset impairment loss. Okay? You actually put that in your income statement. So if you see goodwill, that's what it is. Again, I don't know if it is here. Let me see. Apple may not have it. Okay. First of all, if you look at these statements, it says consolidated. Anybody knows what that means? Or could mean if you don't know what it is? If I talk, by the way, there's no standard name for these statements. Certain companies call it statement of income, certain companies call it statement of operations. I don't know why SEC doesn't require it, but you kind of figure out what it is from the context. So what do you think we mean by consolidated? If you do know. And that's very important for protecting the minority shareholders. Consolidated means if a company has subsidiaries, either wholly owned or subsidiaries in which they have a controlling interest. If you own 51% of the company, you have a controlling interest. You have to consolidate the financial statements. So let's say, for the sake of argument, let's say Apple bought 51% of Google. Okay? And when they're reporting their financial statements, they're going to calculate their sales, for example, net sales, $383 million. That's for 1 year, by the way. I'm sorry, that's $1 billion, not million. They can also calculate how much sales Google had. They add them up. Okay? That's what consolidation means. If you own 100% of that subsidiary, that's not a problem. If you own less than 100%, you kind of are double counting. Let's say Google had $200 billion in sales. So the consolidated would be 583 that is reported, but you don't own 100% of Google. You own only 51. Okay? So technically speaking, the sales that you have to put in there is 102, not 200. But that's not the regulation. The way you correct for that, again, these accountants, you create a contra item, it's called minority interest. So you say, okay, I reported sales of 583, but of that 198 was minority interest. You typically do that for net income, not for each individual items. If you're doing the analysis, it's not a bad idea to actually do that, but you may or may not have access to information in that detail. We'll come to those. All right. Now, in terms of going back to balance sheets. Okay. On the liability side, you list them in the order of when they're due. The stuff that is due the fastest is listed first, and the stuff that is long-term listed later. Any assets that you have due within 12 months is called a current liability. Any assets that's not due during that period is a non-current liability. Sometimes we call it long-term debt. Among the current liabilities, you have typically accounts payable are the stuff that's due the fastest. These are essentially the monies you owe to people. You already purchased stuff, but you haven't actually paid them yet. It's typically trade credit. So I bought something from my supplier. I tell them, I'll pay you in 30 days. That's accounts payable. And more often than not, trade credit is 30 to 90 days. It's kind of a way of giving an incentive for your clients. You know, if I buy stuff on trade credit, my inputs, then I'm going to go ahead and produce whatever I'm going to produce and sell it to the market. So by the time I have to pay you, I already have the cash. So I'm essentially using your own money. Dell, before they went private, was a master at that. The way things work at Dell, suppose you want to buy a new computer, a gaming computer, $5,000 with all the bells and whistles. You go online, give your order, and as soon as they check that your credit card is able to pay that, the system starts generating orders. Dell is a company that actually puts the pieces together. They have all sorts of suppliers. They buy the main CPU from somewhere, screen from somewhere, computer heat fan from somewhere, what have you. And they tell all of them, we'll pay you in 90 days or 60 days or 120 days. But typically they put those together within a day or two. You get it delivered, you get it shipped within about 3 days. And in accounting, as soon as something ships and you know that you're going to be paid, that's considered a completed sale. Okay? They actually book that as profit, but they don't have to pay those guys for the next 90 days. So they're using their suppliers' money for quite a bit. There are other current liabilities. These are typically stuff like short-term debt, okay? Or things like prepaid sales. Somebody paid you the money, but you haven't actually produced and shipped it yet. Okay? Sometimes taxes that are due that you haven't paid yet, those would be current liabilities as well. Sometimes you declare a dividend, but you haven't paid it yet. As soon as you declare it, it becomes a liability of the firm, but you haven't paid it yet, so it's a current liability. Commercial paper is a fancy name for very short-term debt instruments companies issue. They typically have a maturity of 30 to 90 days. You know, Apple takes care of its needs for short-term funding towards that. And the non-current term debt typically means debt that has a certain term. For example, Apple has outstanding, I think, 30-year bonds. And you have the other stuff as well. Then these should be actually down here. Then shareholders' equity has total equity and any accumulated deficit or loss. All right. Now I get about 30 minutes. Let's talk about the nature of the income statement. The apples is pretty simple. On the 10K, you got the expenses and revenues on a 12-month basis. On 10Qs, if it's the first quarter, you get it on a 3-month basis. If it's a second quarter, you get it both 3 months and 6 months, and third quarter, 3 months and 9 months. So if you actually want to know how much sales Apple had on the fourth quarter of 2023 fiscal year, you have to have both 10Q that ended in July 1 versus 10Q that ended in September 23. Why? Don't ask me. Bureaucrats are going to be bureaucrats. That's how SEC requires them to report. That's how they report it. I always make a joke to my accounting friends, and we do something and it's simple, and I say, come on, man, it's just accounting. But the accountants put the numbers in there. We actually tell the story. We kind of put them into real world situations.